Okay, wanted to do a quick slideshow on investments in bonds. This is going to be suspiciously similar to what we talked about when we talked about issuing bonds. Same transaction. We're just on the opposite side of the fence this time. Instead of being the bond issuer, we're the bond buyer. Instead of having interest expense, we have interest revenue. Now, bonds which are held as an investment can be either trading, available for sale, or held to maturity investments. Just as we will virtually never issue bonds exactly at face value, nor on an interest payment date, similarly we will virtually never buy a bond at exactly face value or on an interest payment date. So what do we do with a discount or premium on the bond investment? Do we have to amortize it or not? If a bond investment is a trading investment, we'll usually dispense with the amortization of any premium or discount, since by definition a trading investment is a very short-term investment and the amortization would probably be immaterial. If we're going to hold a bond investment for a week or 2 weeks or a month, then the amortization is immaterial. If the bond investment isn't available for sale or a held to maturity investment, then we will amortize the discount or premium. If it's an available for sale investment, we will also make our year-end fair value adjustment. If it's a held to maturity investment, we will not record the fair value adjustment. Basically, if we're going to hold the bond until it matures, the intervening changes in fair value, while interesting, aren't going to end up being relevant to us. If we have a $100,000 bond issue that we've purchased and we're going to hold it till it matures, whether it goes up or down in value in the interim, we're going to hold it until it matures, at which time we receive $100,000. So to quickly summarize, available for sale investments, we're going to report it at fair value. We're going to amortize the discount or premium, but we'll still report it at fair value. Held to maturity investments, we're going to report at amortized cost. Okay, let's go ahead and run through a quick example of this. Assume that on January 1st, 2015, we purchased $100,000 of the 10% 10-year bonds of ABC Company. The bonds have 4 years left to run. They mature 12/31/18 and are bought to yield 8%, a purchase price of $106,624.26. And again, this is intuitively appealing, or this confirms our intuitive expectations. These bonds pay an above market rate of interest. They will be very attractive to bond buyers. The price will be bid up and we'll have to pay a premium to acquire them. So let's go ahead and assume these are a held to maturity investment and that we're going to use the effective interest method of amortization. So we record the purchase, and we're going to go ahead and record the entire purchase price of $106,000 as the investment in bonds. We don't separate it into face value versus premium as we did when we were the bond issuer. Instead, the entire purchase price is rolled into the investment in bonds account, including any acquisition costs we might incur. At the end of the first year, we record our interest receipt and amortization. Now, the bond investment has a carrying value of $106,624.26. Under the effective interest method, interest revenue will be 8% of that, or $8,529.94. The cash received is the coupon interest of $10,000, the difference being the amortization. And again, just as we included the premium on the bond investment in the investment in bonds account, when we go to amortize it, we will simply credit the investment in bonds account. Similarly, for the end of the following year, after the first year, the carrying value of the bonds is down to $105,154.20. Interest revenue will be 8% of that. Again, that's the effective or market rate of interest. We receive our $10,000 in cash. The difference is the amortization of that bond investment premium, and again, we simply reduce the investment in bonds account.